In this video, we're going to be looking at the effects on the accounting equation. Here's a reminder of the accounting equation, and that's assets equals to liabilities plus owner's equity. For this video, we will be referring to the general journal for a credit sale to identify the effects on the accounting equation. First, we're going to look at identifying the effects on the accounting equation when the transaction is recorded. I'm going to use this example here of a credit transaction, credit sale, and we're going to refer to the general journals to help us out with identifying the effects. So looking at accounts receivable, it is an asset that has increased. So under asset, I'm going to write down here that the AR, accounts receivable, has increased by $5,500. Next, we have the sale, which is a revenue, and revenue affects profit, profit affects owner's equity. So under owner's equity, we're going to write down that the sales has increased by $5,000. That's a revenue here. We then have the GST clearing, and that is a liability that we are recognizing since this is a GST payable on a sale. And so that means the liability has increased by $500. Then we have inventory, which is an asset, and that has decreased by $3,000. And lastly, we have an expense here, which is the cost of sales, and that has increased by $3,000. And the reason why we put it under owner's equity is because expenses will affect profit and profit affects owner's equity. But we won't stop there because we have to find out the overall net effect on each of these elements. So for asset, since there was an increase by $5,500 but also a decrease by $3,000, so therefore, we have a net increase of $2,500. The liability is easy. There's only one effect there, and that's an increase of the liability by $500. Now, for owner's equity, there was an increase in sales and also a recognition of the expense, which is the cost of sales. So this shows us from this sale, we have a profit of $2,000, which will increase the owner's equity. So the overall effect on the owner's equity would be an increase of $2,000. Next, we're going to explain the effects on the accounting equation when the transaction is recorded. It's the same process as we used earlier when we are identifying the effects on the accounting equation. The only difference now is that we're putting it all in full sentences. So I use this structure where we are clearly stating the effects in the assets, in the liabilities, and in the owner's equity. So those will be our sentence starter. In the assets, accounts receivable increased $5,500, inventory decreased $3,000. Now, this is the key part here. Well, after you have identified the specific increase in the asset accounts, we have to state that the overall assets has increased by $2,500. Now, in the liabilities, there was only one effect. So the GST clearing, which is a liability, increased by $500. That's easy. Overall, the liabilities increased by $500. In the owner's equity, the sales revenue increased by $5,000. Cost of sales expense increased by $3,000. And therefore, the profit increased $2,000. And again, making it specific to the owner's equity increased by $2,000. So note here in the owner's equity, we have to be very careful to ensure that we are showing the effects on the sales revenue, the cost of sales expense, and how that affected the profit, which then affects the owner's equity. Next, we're going to look at identifying the effects of the accounting equation when the transaction is not recorded. Now, instead of using the words increased or decreased, this time we're going to use the words overstated or understated. Okay, just going to write that here. So instead of using the words increase or decrease, we're going to say whether something was overstated or understated. Now, to help you with this, I'm going to give you a little shortcut here so that it's easy for you to analyze this, and this will help you minimize any careless errors as well. So you know how when we were identifying the effects of the transaction earlier, when it is recorded, we've already established the increases and decreases. So now I'm going to use that same logic here, but this time I'm going to explain to you the logic as to what happens when the transaction is not recorded. So let's start with the accounts receivable. It says here that it would have increased assets by $5,500. Now, if the accounts receivable was not recorded, therefore the increase would not have happened. And if the increase did not happen, therefore, the accounts receivable would have been understated by $5,500. So that's US there for understated. On the other hand, inventory, instead of it decreasing if the transaction was recorded, but if it was not recorded, the inventory decrease would not have happened. And that means the inventory would therefore be overstated. So that's OS for overstated. So overall, the assets would not have increased by 2005. Instead, it would have been understated by $2,500 because the increase did not happen when the transaction was not recorded. Now let's look at the liabilities quickly. GST clearing would have increased if it was recorded, but because it was not recorded, the increase did not happen, and so therefore liabilities would be understated by $500. Same goes here with the overall liabilities. The increase would not have happened, therefore it would have been an understated amount of $500. In owner's equity, the sales would not have been recorded, and therefore the sales would have been understated. And the cost of sales expense would not have increased if the transaction was not recorded, and therefore cost of sales would also be understated. Overall, the profit would have been understated because the increase in profit was not recognized when the transaction was not recorded. And overall, in the owner's equity, the increase would not have happened. Instead, the owner's equity would be understated by $2,000. Now we're going to look at explaining the effects on the accounting equation when the transaction is not recorded. So using the same method as we just did, we're going to use this sample response for when the transaction is recorded, and we're going to switch it around with the words understated and overstated so that this response is the effects when the transaction is not recorded. So we're going to start off with in the assets. If the transaction was recorded, the accounts receivable would have increased by $5,500. But since it was not recorded, that means the accounts receivable would be understated by $5,500. Inventory would not have decreased. And that means it would have been overstated by $3,000 if the transaction was not recorded. So overall, the assets would not have increased. So the assets would have been understated by $2,500. Now in the liabilities, the GST clearing liability would not have increased if this transaction was not recorded.
So that means the GST clearing liability would be understated by $500, and overall the liabilities would also be understated by $500. Lastly, in the owner's equity, if the transaction was not recorded, sales revenue would not have increased, which means the sales revenue would have been understated. And cost of sales expense would also not increase, which means it would be understated. And therefore the overall profit would not have increased, but instead it would have been understated by $2,000. So overall the owner's equity would not have increased. Instead it would have been understated by $2,000.